It's almost 1 p.m. in Sydney, 11 a.m. in Hong Kong and Shanghai. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. A tech rally extending in Asia, helped by Tesla's surge on its promise of cheaper cars sooner. Sense time soaring in Hong Kong as it launches a new AI model. Also ahead, we look at why a legion of fleet-footed Chinese retail investors could be behind gold's record-setting rally this year. And President Biden set to sign a bill forcing ByteDance to sell or shut down TikTok after the legislation passes the Senate with bipartisan support. Well, we're going to get a check of markets in just a moment, but first let's get a little bit more on that TikTok ban or divest bill. The US Senate just voting to pass the measure. It's now awaiting President Biden's signature. Now, the legislation also includes aid to Ukraine, Israel and Taiwan, and one sweeping bipartisan approval. So for more on this, we're joined by our congressional reporter, Stephen Dennis in Washington, D.C. Stephen, thanks so much for joining us. So that bill basically just waiting the president's assent now. It's all but certain. The scene now set for a legal battle, it seems. How long could that drag on for? And what does it mean for a debate around the First Amendment?
Yeah, I think there's going to be, there's already promises that the company will file lawsuits trying to overturn this law and saying that it's unconstitutional and violating the First Amendment right to free speech. But the lawmakers say that they're very confident they'll prevail because this is a foreign-controlled company, and there's no right to free speech for a Chinese company. The right to free speech is for the people on TikTok. And so the argument is that this is very similar to regulations that the government has on who can own broadcast stations, for example, or radio stations. They've had these kinds of regulations in the past, but of course this is an immensely popular social media network that 170 million Americans are using. And so that makes it such a valuable resource if you're the Chinese government. And this is, something where it's going to be hard to see why China would be willing to let it go and let the algorithm and the wealth of data that it has potential access to here turn over to the Americans. So it's going to be potentially a long, dragged-out fight, although the legislation itself, it's supposed to be resolved, this divestment, within a year. But that'll be up to the courts to decide.
Yeah, the divestment within a year, so that takes us well past the US election. But in terms of a Chinese response, I mean, we've got the Secretary of State, Antony Blinken, about to head to China. To what degree is this going to dominate the agenda?
I think it's going to become one of the big issues between, U.S. and China relations because, if you think about it, there could be sort of tit-for-tat kind of things with retaliation. And there's certainly a lot of American companies doing business in China as well. And so I think that's something to watch, is whether this will have broader impacts on the overall relationship, very important economic and political relationship between the two countries. But one thing that was clear, just talking to senators in both parties this week, is just how badly the lobbying effort, which was sweeping, expensive, and by TikTok to prevent this vote, just backfired. Senators were irate that even their own children were coming under assault. The children who were using TikTok were getting inundated with messages saying, contact your senators to tell them to oppose this bill, and they felt that was heavy-handed. So we'll see sort of what happens next, but I don't think there's a whole lot of love right now for China generally in the Congress, and certainly having this kind of control over something that half of Americans are using.
Yeah, this battle probably really only just begun now. Congressional reporter Stephen Dennis there in Washington, D.C. All right, let's take a look at how markets are faring with Avril Hong in Singapore. Avril, looks like a pretty positive day so far.
Positive day, and we're seeing the stocks as well as the currencies climb. It's really about the earnings. I mean, coming into this week, we knew it was going to be a key test of whether U.S. equities could continue their bull run or even justify it. And so far, after the first of the Mag 7s, Tesla reported, we're seeing things quite promising, and that's driving that rally in the Asia Pacific today. The Japanese, Taiwan, South Korean gauges are seeing more pronounced moves compared to the past two sessions. Hong Kong, something we're highlighting as well. It's one of the world's best performing markets this week, and the Hang Seng has erased the losses for the year. We're seeing a read-through from the tech rally into the FX space as well as the Korean won climbs. And thanks to those stock market inflows, keeping an eye on the Aussie after a hot inflation print. But let's flip the board because I want to look under the hood, take a look at the EV complex and what is driving some of the moves in the Asia Pacific. The Hong Kong listed peers of Tesla are climbing, along with some of Tesla's South Korean and Taiwanese related suppliers. And to be clear, it's missed on sales, but I think that acceleration of the launch of new models helped to allay some of the concerns about its strategy, because arguably the lack of new models is what is driving that sluggish growth for Tesla sales in China. And we're seeing among the chip names, the South Korean, Taiwan, Japanese ones, they are the ones that are climbing after Texas Instruments, seen as a bellwether for the sector. It gave a pretty solid forecast, so that is driving the moves in the Asia Pacific today, Paul.
All right, thanks very much, Avril. Well, Avril mentioned Tesla there. Tesla shares surged in late trade after a promise to accelerate the launch of more affordable models, and that followed a decline in first quarter profit margins and sales. Let's get over to Bloomberg Asia transport reporter Danny Lee in Beijing. Danny, it seemed like a fairly ebullient Elon Musk on the call, cracking a few jokes even about alien abduction. But when it comes to low-price models, what's coming next from Tesla, they were really kind of coy, weren't they? We don't know exactly what we're going to get, and we might have to wait until August to find out.
Yeah, on to the serious stuff that Elon Musk really needs to talk about and address. And it's the lack of detail, but some detail, in fact. The fact that Elon Musk, Tesla, will be putting forward a low-cost EV set of affordable models as early as next year, rather than the back end of 2025. And that brings forward the potential growth story for Tesla forward by around 3/4. And that's important because of what Tesla is facing is notably lower growth going forward, because it doesn't have a lot of products out there that will help scale and drive its revenue. And particularly because it does have a kind of model base that is thin, it's getting ever older, it's not being necessarily as refreshed as much, and so therefore it's very much behind on peers, not just in the US where the EV market is slowly growing but stalling in some regards, but in China where the world's biggest auto market and EV market is really on a tear and fighting for competition is price cuts. And Tesla has been trying to drive its performance through price cuts, but it has been struggling a little bit, and this is why this affordable model is to try and drive some of that momentum back into its stock in particular.
Yeah, well, the market was braced for a pretty horrible quarter, and a horrible quarter we got, but we still saw the stock rising very aggressively after hours, and this is even though short interest in Tesla's at a 2.5-year high. So is the stage kind of set here for another battle between the Tesla short sellers and the Tesla true believers?
Yeah, particularly the true believers being the retail investors who believe in Elon Musk, believe in that story, particularly the robo-taxi, and therefore, for someone like a Tesla shareholder, it's been a lot of a beating of late. But as long as Elon Musk being focused on eking out those cost cuts, particularly with the job shedding last week in particular, it is trying to put itself forward onto products it clearly thinks is going to help drive the stock forward and put it in a place where it can actually see the ground that it doesn't have as much competition in.
All right, Bloomberg's Asia transport reporter Danny Lee in Beijing. Well, let's take a look at how we're shaping up in terms of US futures, very much reflective of what we're seeing in Asia right now, very much in positive territory. We've got S&P E-minis better by 1/3%, NASDAQ futures better by 3/4%, and the market will be looking to see if that big after-hours jump in Tesla translates to a big jump at the US Open the next day as well. Let's take a look at currency markets as well. A little bit of softness going on at the moment. The dollar spot index pulling back a tad, and we are closely watching the yen. Well, we're always closely watching the yen, but we've been hearing a little bit more about the possibility of intervention as it hovers just below that 155 level. We do have a Bank of Japan meeting starting tomorrow, and the BOJ has pledged that putting a floor under the yen going to be a priority for them. Okay, let's get to Wayne Gordon, Managing Director of Commodities and FX at UBS Global Wealth Management. And Wayne, I want to start on currencies today. We've really seen traders pairing their bets over the past few days about Fed easing. Do you feel like this is now becoming maybe a 2025 story when we get rate cuts from the Fed? And what's that going to mean for persistent US dollar strength?
I think very much, Paul, it's a data-dependent story, and clearly the data in the US has surprised us to the upside this year. I think, though, looking forward, clearly there is still evidence that inflation will moderate in the back end of this year and as we go into 2025. Definitely, we started the year with a sort of 3 to 4 rate cut sort of view of the Fed. We were pretty modest compared to some market expectations. And as we've moved through the year, we too have had to pare that back a little bit. We now think that there's probably most likelihood is 2 rate cuts. September and December are targets at the moment. Of course, you've got that US election in the middle, which muddies the waters a little bit for the Fed, or at least historically it has. Yes, a little bit of dollar strength in the short term is most likely, particularly given we have these pop-up and geopolitical risks as well, which the dollar has been performing very well as a sort of safe haven currency in those periods. So these sort of ongoing geopolitical etc. We'll see the dollar on a bit of a firmer bias, at least into the middle of the year. That being said, there are currencies which can lean against that, and the Aussie dollar in particular is something I know you guys were talking about earlier. We had expected a sort of above expectation inflation print for today, given the way wages, etc., are playing out and the tightness of the labour market in Australia. We have, the Aussie dollar is the most preferred currency for us. We have a target of the high 60s by the end of this year and into next year. And for me, the Aussie has been trading very much on the rates differentials, but actually things like copper, iron ore have recovered nicely with this pickup in manufacturing. We're starting to see on a broader basis. Globally, we think the commodities are going to be pretty well bid, and so consequently we do favour the Aussie dollar on that basis as well.
Yeah, and the Aussie got a nice bump a little bit earlier as well, and the hotter than expected first quarter CPI print suggests that maybe the RBA won't be easing anytime soon either. But I do want to talk to you about the yen as well. We've got the Bank of Japan pledging to prioritise yen stability at its next meeting. That starts tomorrow, of course. Are there any measures that you're anticipating, and would they be effective?
Look, I think that definitely the short positioning in the yen is at extreme levels. So any murmurs or comments by the Bank of Japan to some line in the sand for the yen around about that sort of 155 level is clearly going to create yen volatility in that context. But in the end, the fundamentals for the yen continue to reflect the differentials on the rate side. We think that the Bank of Japan remain pretty cautious to be lifting rates in the current environment. And as a consequence, I guess that we do expect that, this sort of 155, while not a hard line in the sand, definitely will have some resistance to it. And then as we go through the course of the rest of this year and into next year, we expect the yen to weaken. That being said, we have pared back our yen weakness, our yen strength, I should say, as we go into next year, largely because of that the trimming of our US Fed expectations for cuts in the back end of this year. So we still continue to expect the yen to recover, albeit that may be delayed in the short term, and that recovery might be a little bit less than what we had anticipated earlier in the year.
All right, Wayne Gordon is sticking with us. Wayne is with UBS at Global Wealth Management. We want to get your views on commodities in a moment, but still ahead later this hour, we're going to be talking to former Tech Mahindra CEO CP Gunani. He'll be joining us to talk about his new AI business venture that is called AI on OS. And we'll hear why he decided to jump on the AI bandwagon. That interview coming up later on this hour. This is Bloomberg. Gold's record-setting rally this year has puzzled some market watchers. Prices have been roaring higher, and that's despite headwinds that probably should have held it back. But with prices sagging this week, some believe the explanation may lie in China. So for more on this, let's bring in our Asia commodities reporter, Sibylla Gross. Sibylla, okay, what's this theory? Are Chinese consumers behind this gold rally? What's going on?
I mean, China's been a huge market for gold for quite a long time. We've seen persistent demand for physical from the consumers, and we've also seen the PBOC buying up a lot of gold. But recently, what we also have noticed is a huge spike in volume or trading activity on the Shanghai Futures Exchange. That's kind of unusual because we're not seeing that volume of trading activity in, the biggest futures market for gold in New York, and we're seeing trading activity jump overnight in New York. So it does kind of suggest we're seeing a huge speculative demand in China playing out in more recent times as on top of the physical demand.
All right, Asia Commodities reporter Sibylla Gross there in Melbourne. Okay, well, Wayne Gordon is back with us. Wayne is Managing Director of Commodities and FX at UBS Global Wealth Management. Wayne, I know you've been raising your gold forecast in view of firmer demand. As Sibylla was talking about there, how much of this is a China caution story, and where are the rest of the pressures coming from?
In your intro, you've really pointed out the challenges that many people have faced. Usually a stronger dollar, higher rates tends to mean lower gold prices. That couldn't have been further from the truth over the last couple of months. I think the key thing for us is, and part of the reason why we lifted our forecast recently, I just want to give a bit of a sense around that, though, that while we did lift our forecast, we had a forecast for $2,300 an ounce in the short term at a period when gold was trading close to $2,400 an ounce. But longer term, we see this diversification trade for gold continuing in a pretty strong way, and hence the reason we have the 2,500 forecast as we go into next year. I think the keys to this has been that China demand has been very much undervalued by many parts of the fundamental story, and I think also a level of underreporting. I think as well, often it's very difficult to get a handle on the flows going into China and where those flows are going to. I think the key thing for us is, though, that Swiss exports of gold to China, Hong Kong, have been very strong over the last, in the back end of last year and also this year. And on the back of that, I think official sector buying has also a little bit gone under the radar. And of course, it also is a little bit more difficult to track some of those flows. But at least anecdotally, from what we understand, the demand for gold from the official sector has also been very strong. Of course, these dynamics have been playing out in gold for the last couple of years. And that is indeed what's seen gold continue to lift in prices, despite often you saw interest rates rising, or even real interest rates, which is key for gold, also rising and sort of creating this interesting dynamic where some of those traditional drivers have not necessarily been driving the price of gold. Overall, the consolidation we're seeing right now is broadly expected from our perspective. As I said, we had a target of 2,300 by the middle of this year. So this consolidation we see is really healthy. Obviously, this spread between Shanghai prices and London prices has been very much a feature. And that is also very understandable from a fundamental perspective, because you have a quota for imports of gold into China. And of course, there's been a lot of pressure on that quota because really, if you want to diversify your investments in China, there isn't much else. You know, the real estate market has been under incredible pressure. The stock market has been highly volatile, and gold has been, the volatility of gold has been very low in comparison to those other ideas. You know, for us as a wealth manager, we've always advocated clients use gold as a diversification within a broader portfolio context. And I think that's what's important to keep in mind here.
Wayne, just got a couple of minutes left, but I do want to get your views on oil as well. Even though we've seen tensions in the Middle East abating somewhat, the price has been ticking up over the past 24 hours or so. What's your view on oil, and are you a buyer of energy names?
Yeah, look, we like oil. You know, we're trading oil in a sort of range between US 85 a barrel and $95 a barrel. We like the ownership of diversified energy in particular. US energy is a key call for us. So from the view perspective, the market is still broadly undersupplied. The upside to growth in the US, of course, has also led to an upside on the demand for oil. Of course, what's keeping oil a little bit more subdued in these, you know, geopolitical spikes is largely around there is a reasonable amount of spare capacity sitting in OPEC. OPEC can respond, particularly Saudi Arabia can respond with that spare capacity if required. Of course, they've been very much sitting on their hands, I guess, with respect to any movements in increasing capacity, etc. And that has seen the oil market remain relatively tight. We do think it will remain tight going into the summer. We expect seasonal demand for gasoline starts to pick up. And as a consequence, we think oil prices can continue to maintain this range. That being said, the energy companies are probably a good opportunity to not only be buying in, and it doesn't quite reflect these more elevated levels of oil prices, at least the valuations don't yet, but also the fact that they are returning cash to shareholders. And we think that this is a really important dynamic that people should be still allocating to these traditional energy companies within a portfolio context over the longer term, because in the end, demand for oil continues to rise, and we think the price is very well supported here.
All right, Wayne Gordon, thanks so much for joining us with your insights. Wayne Gordon there of UBS Global Wealth Management. We have plenty more ahead. This is Bloomberg. All right, if you're holding this stock, Sense Time, I congratulate you on the very nice Wednesday that you must be having. Better than 30% right now. And in fact, the stock has been suspended because of this huge gain that we've seen. Sense Time has unveiled the latest version of its Sense Nova generative AI model, so the market very excited about that. However, we do have some Bloomberg intelligence analysis for you, which suggests maybe you want to breathe through your nose a little here. It says, although Sense Time has deep technological expertise in AI, but lacks a competitive edge, it is a small player, might continue to struggle against Tencent, Alibaba, Baidu and Huawei. Whereas their Sense Time shares there better by 31%. Plenty more to come. This is Bloomberg.
We can say that the relationship is getting worse. It's true, but it's getting worse quite slowly. And there's more stability to the relationship, but that when there is conflict, the conflict does not escalate out of control. Rather, the escalations are targeted and calibrated.
It's Ian Bremmer, founder and president of Eurasia Group. He was speaking to us earlier. lack of silence at the moment between the US and China. Of course, Antony Blinken, Secretary of State, is on his way. I suspect he'll be having some interesting conversations about TikTok divestment. Anyway, we've got mainland markets about to head to their lunch break. Here's how we're doing. CSI 300 looking pretty flat right now, but elsewhere some of the other benchmarks performing better. Got the Shanghai Composite better by 1/3%. The offshore yuan at the moment holding pretty steady there at 7.2456. All right, we've got Japan about to return from its lunch break. Avril Hong's here for a look at what's been going on in Japanese markets. And Avril, very much a risk-on sentiment today.
Yeah, risk on, but we're also first checking in on what we're seeing on the Japanese currency. As you know, Paul, that yen weakness doesn't show signs of stopping, and that's despite this chart here, which shows you the relative strength index. The yen, dollar yen, has been in overbought levels in the past 2 weeks. Now, we are watching that 155 level, and our MLife contributors have been talking about the US GDP numbers that could potentially be the first window of when that reaches the level, because steady growth is expected. That could mean stronger dollar. There's also been some debate on just the levels of short positioning, and I'm sure you get into that with our MLive colleague Mark Cudmore in just a bit. But let's take a look at what we're seeing in the Japanese stock markets as well, as the Nikkei has been showing a more pronounced move today compared to the past 2 sessions. It's being driven by the chip making and the EV related stocks, as we got the likes of Tesla and Texas Instrument improving some of the market sentiment thanks to what we heard post earnings, and that is driving the moves in the stock markets for now. Paul.
All right, thanks very much for that, Avril. Let's stay on Japanese assets now. Bloomberg's Markets Live strategists say shorting the yen, not exactly a crowded trade right now. They also believe that any rally spurred by action from Japanese authorities will likely end up being brief and far from brutal. All right, for more on this, let's bring in MLive Executive Editor Mark Cudmore. Mark, we are on the eve of the BOJ meeting, and the Bank of Japan has suggested it's quite eager to put a floor under the yen. It's the Ministry of Finance's job, though, to conduct intervention. How close are we to some sort of policy change from either the BOJ or the Ministry of Finance?
So there's two sides to the story, as there's to everything. I think the first way to look at it is that there's almost nothing priced for the Bank of Japan, and therefore the risk reward is probably to position for some kind of hawkish surprise from the Bank of Japan, and that makes sense. There's also precedent for a Friday afternoon New York intervention from the MOF after a disappointing Bank of Japan. That happened, I think it was in September 2022. I may have my exact month wrong. So there is a potential that we get intervention this week. However, there's a couple of other qualifiers here for why generally I remain very bearish the yen, even if the risk reward is less advantageous to be bearish this week. And the reasons are, first of all, people have got very excited by the CFTC short positioning, but the CFTC is only a small subset of the market. It's the CTAs. It is not a catalyst for reversing the trend. It can give a rebound in the yen momentum if it really rebounds a long way, but it needs a separate catalyst. Second of all, there is no reason for the MOF to come in and intervene at the moment. Sure, yen is at a multi-decade low against the dollar, but the pace of decline is not drastic, and it's in line with fundamentals. Until US yields start turning around more dramatically and coming lower, I just don't see intervention really working. So I think that the positioning is not too stretched. I think the discretionary traders have been reluctant to get particularly short the yen because that risk reward of the BOJ coming up, because that intervention risk. And I think that even if we do get intervention on our Friday afternoon, which could be more powerful, well, then that will really just be seen as a chance to re-short the yen by those discretionary traders who are standing aside at the moment. Overall, the story is Japan offers deeply negative real yields, not a particularly attractive growth story. It is suffering from the commodities boom. This is not a currency with any major fundamentals behind it. Sure, it's cheap, but cheap things can keep on getting cheaper if there's no reason for them to rally.
Yeah, there's a lot of macro factors stacked against the yen at the moment. And I mean, chief among them, I guess, also is those Fed easing bets just keep on getting cut back. I think we're down to 1 or 2 potential rate cuts this year. So with that in mind, even if intervention did get conducted, is it worth it?
Well, exactly. This is why I think that the MOF, kind of directed by the Bank of Japan, will be very reluctant to intervene. They want to keep to verbal intervention because they know that if they come in and actively intervene, it matters for a few yen, it matters for a day or so, but ultimately the world's going to go, brilliant, you've just given us better levels to sell the yen. And that's what I think is holding back the MOF from kind of action rather than words. And you're right, and ultimately the trend for higher US yields has more to go. We're still pricing in rate cuts in the US. Why are we pricing in rate cuts? Where is the growth slowdown? Where is the deflationary trend? There is no justification at the moment, nothing obvious, unless it's a hidden problem, and there's no sign of that. There's nothing obvious for why the Fed will cut rates at the moment. So overall, there's still room for US yields to move higher, which is going to put further upward pressure on dollar yen. So therefore, this week is the week where intervention risk is a risk only because the Bank of Japan meeting and because there's a risk of a hawkish surprise. This is not the week where people want to be long dollar yen, which is why discretionary traders are standing aside. But if there's intervention, they'll pile in long dollar yen. And if we get through this week without intervention, without a hawkish surprise, they'll also pile in next week long dollar yen either way. So either way, people are going to push dollar yen higher next week. It's just what level we push it from.
On the subject of piling in, Mark, we saw Tesla having a huge surge after hours today, even though that first quarter set of numbers was every bit as disappointing as we thought they were going to be. The outlook was pretty good, and it seems like investors and traders have decided, yeah, actually, one swallow does make a summer. Are the bulls all back on equities now?
Look, as you know, Paul, I am very deeply in the bullish camp for stocks all year. And I don't get down to the micro. I'm not kind of studying why Tesla has suddenly rebounded now, but it has had a very, very large decline. So I don't look at the single name stocks. But, it is good sign for bulls like me that even mega cap tech, and this week where 4 of the Magnificent 7 are reporting earnings, that they are kind of driving this rebound right now. But I think the rally in stocks should expand. I think it should go to emerging markets. I think it should go to value stocks. I think generally there should be a broadening out of the rally here. The macro factors are really good. Global growth is picking up from too pessimistic expectations, and we have central banks where they still have a very dovish reaction function. Sure, we're going to see higher yields, but we're seeing higher yields for the best possible reasons because growth is much stronger than people thought. We're not seeing higher yields because of bad reasons where it's just inflation and no growth. This is a positive stocks environment. It's a growth environment where consumers will keep spending. That means earnings will keep growing.
Mark, as you finished off your thesis there, we've just put a chart up on the screen. It's JP Morgan's price target for the S&P. That's at 4,200. So you have a bit of competition from the bears when it comes to your outlook. What are the risks to your bullish outlook?
Genuinely, I don't see major near-term risks. At some point, obviously, like any bull market, it will come to an end. But I don't see why it's going to come to an end on a very short-term basis. People worry about valuations, and assets are expensive, but they're not crazily expensive. They're just expensive. And they're expensive for a reason, because the macro backdrop is good. So you look at where will be those big risks that are going to take down this market. Is it commercial real estate? No, not systemic. It's going to be an ongoing problem, but not systemic. Is it regional banks in the US? No. 1,000 regional banks could go bankrupt. We'd still have too many banks in the US. It would be very, very problematic for many sectors, many states in the US. But we already know that, sadly, the US economy is very bifurcated. It is driven by a bunch of companies in a bunch of states, and therefore that will keep the economy charging on, will keep the consumer spending. I am not seeing a systemic risk. Now, there can always be a black swan, but by definition, and people often misunderstand this, a black swan is a risk that I cannot identify and not predict, because that's the whole point. It's something that is not possibly on my radar yet. Otherwise, I expect volatility to continue because yields will continue to go higher and therefore raise the discount rate, which makes it harder for stocks. But they're rising for the right reason, and that's why through the volatility, stocks will continue to climb the wall of worry for now. Maybe something will change in a few months, but we're a way off yet.
Yep, we can't talk about the unknown unknowns. MLive Executive Editor Mark Cudmore there. Thanks for joining us. Let's take a look at the rupiah. That's something we do know about. It's getting fairly soft at the moment. 16,000, I beg your pardon, 169 right now. It's slipped about 5% since the start of the year. And this is a very live currency at the moment because we are awaiting Bank Indonesia's policy decision. We're expecting to get that in just a few hours' time. Now, according to a survey of economists, the central bank could postpone monetary easing to later on this year, if not early 2025, as it waits out some of the uncertainty around the Fed's rate path, as well as the continued tension in the Middle East. So for more on the path of the rupiah, let's get over to Bloomberg's Indonesia economy reporter, Claire Zhao. So, Claire, you're following the Bank of Indonesia today. Not consensus about this decision. What are we expecting?
We're expecting cooler heads may just prevail today for Bank Indonesia. The central question facing the central bank is the rupiah weakness temporary or will it be persistent? And after a huge drop last week, we're seeing a bit of risk on sentiment coming back. We're seeing the rupiah getting a bit of relief. It's on its third straight day of gains and is up as much as 0.4% today. So that may just be enough to convince policymakers to hold the BI rate at 6% and instead rely on raising its hawkish stance and saying that we'll just use our interventions in the spot, the bond, and the NDF markets to weather any volatility that may come up. That being said, we really can't rule out any surprises when it comes to BI. It's not averse to surprising the markets. So if there's any rupiah weakness that may still filter in today, expect the decision to come down to the wire, and that may still swing their calculus. If we're looking at how BI positions itself in previous decisions, it tends to act fast and act big just to prevent any further weakness from hitting the rupiah hard.
Yeah, there must be a temptation, surely, to deliver a surprise rate increase like how they did back in October. What's the balance of probabilities around that?
So there's a slim majority of economists who do see a rate hike could still happen now, but we do have the benefit of hindsight from what they did in October. The rate hike that they delivered then in the wake of the Hamas-Israel war ended up spurring more outflows as investors tended to view it as a panic rate hike instead. So there is a sense that 25 basis points may not really be enough to stand against bigger external factors such as a possible Iran-Israel war and the Fed's rate pivot that's getting delayed. So Bank Indonesia will want to stay calm and instead preserve its bullets and not waste it on any knee-jerk reactions. And that means its rate cuts for this year may also be delayed. It signaled earlier that it may happen as soon as the second half of this year. That may be pushed back to the fourth quarter or even in 2025. And Bank Indonesia is not alone in this fight. It's become an all-of-government effort really to stabilize the rupiah that's reached 16,000. You also have the government telling its state enterprises to stop making large dollar purchases, and it's also telling its exporters to start repatriating its dollar earnings just to start building up that dollar war chest again.
All right, Bloomberg's Indonesia economy reporter Claire Zhao there, awaiting the Bank of Indonesia decision. Now, still to come, our exclusive interview with the former Tech Mahindra CEO, CP Gunani, and we're going to hear why he's decided to bet big on AI. He's got a new business venture with Interglobe. We'll hear all about it shortly. This is Bloomberg. All right, let's take a look at how we're tracking on Indian markets at the moment. The Sensex showing some modest gains at the open, about a third of 1%. Those gains are fairly broad-based as well. We've had Indian rates traders pushing back expectations for an interest rate cut. Meanwhile, maybe a little bit too far, according to Bank of America. Reserve Bank of India likely to cut its key policy rate by about 100 points in the next 2 years. But there is a feeling from Bank of America that maybe that's a little bit too aggressive. But if we take a look at how stocks are performing, well, it's very much in line with what we've seen across the rest of Asia at the moment. The Sensex there better by 0.25%. The Nifty rising also by a similar amount, and pretty much echoes the risk-on tone that we've seen across the region. Okay, we're still waiting to connect with our next guest. While we achieve that, we'll take a short break and we'll be back shortly. This is Bloomberg. Shares of Europe's biggest software company, SAP, rose the most since January after it forecast record revenue expansion from its cloud services. CFO Dominic Asam told us it's all down to the boom in artificial intelligence.
The advent of AI has clearly propelled the story of the transformation to the cloud to move our customers from their on-prem installations onto cloud, resulting in an uptick on a constant currency basis by 25% in our cloud revenues. Our more forward-looking so-called CCB, which is basically the 12-month ahead subscription revenues we've already contractually locked in, is even growing at 28%. That's a record growth. And all that is driven really by the core offering we have in the cloud, which is called the Cloud ERP Suite. That offering has actually generated in excess of 30% growth for 9 quarters in a row now.
What is the demand, Dominic, in terms of the specific applications of artificial intelligence in the cloud that you see most commonly invested in by the companies who are your clients?
Well, it's a broad set of applications throughout the enterprise, on HR, on finance, on the supply chain. So there's actually no exclusion, I would say. It's really, really broad. We have brought about 30 use cases recently to the market. We are planning another 100 to come. We already have more than 27,000 customers using AI-powered use cases in the corporation. The 300 million users we have by now in the cloud are really benefiting to make themselves more productive and to fight, for instance, rising inflation and salaries.
How much are you winning market share versus simply just capitalizing on the incredible demand that we see right now for artificial intelligence?
Well, undoubtedly on the Cloud ERP Suite, we do win market share. I mentioned the 30% plus growth we have. The market is more in the low to mid-teens. So that's a very tremendous outperformance. It's like more than twice the performance of the market.
So from who? Who are you gaining market share from in particular?
Well, sometimes it's kind of homemade solutions we are displacing. Sometimes it's also against our key competitors. It's also the fact that SAP has been more focused on the on-prem installations, that is software deployed by the customers. Now we're really moving to the cloud. So we can convert that huge customer base on-prem into the cloud, and that drives the growth.
That's SAP CFO Dominic Asam speaking there to Bloomberg's Lisa Abramowicz. And our next guest has just launched a venture called AI on OS, targeting clients in the travel, transport, logistics and hospitality industries. Joining us exclusively now, CP Gonani, Executive Vice Chairman of AI on OS. And you might remember him for playing a key role in Tech Mahindra's transformation journey as well. CP, thanks so much for joining us. First of all, I just wanted to you to talk us through this new venture of yours, AI on OS. So what is it? How does it work?
Thank you, Paul. And I think we are very, very excited because technology has never had such an exponential leap as what we have seen with not only the conversational AI, not only the Gen AI, but cognitive AI, all coming into shape to create solutions. Number two, we work with partners, who are willing to go that extra mile. Help clients define how to not only structure the data, but actually bring it for a usage, taking into account the compliances of each of the country. The third part out here is customer experience. A customer in a normal situation, I think everything goes fine. It's only when there is a disruption, when there is a flood. I mean, we just saw the floods in Dubai. When we see the hurricanes in some different part of the world. I think what we see is that is the time how to make sure that we start viewing things from a customer point of view. And this particular segment has done well on a localized level, the whole of TTLH. But I think there is a requirement of combining pieces of technology and powering AI for the customer.
CP, a lot of the AI power is within large companies at the moment, like Microsoft, Google, Meta, and Facebook. Can Indian startups compete with these giants, and should they?
I think that's the best part of this life, that on one end, I mean, you just had an SAP guest on the show. We work with SAP, we work with Microsoft, and we will definitely be working with some of the startups, because what we are doing is actually creating an operating system. And that's why we named the company as IONOS, AI on OS. And that OS will integrate what is already available. We are not here to reinvent everything. And I'm very happy that there is so much of recognition that AI with human touch, and that's what IONOS is all about.
So where does India have an advantage in the AI space then? And how much money do you think there is to be made in this sector?
Ultimately, we are here to build an institution. We are here to create a service offering which appeals to our customer, which appeals to our own people, and which is also relevant. So I'm sure there is a net business effect. But at this stage, we are having fun creating IONOS as an institution. It's a Greek word which means everlasting, and I do believe we are creating a great institution.
Are there potentially some risks here as well? Places like India, also the Philippines, a lot of coding work gets done there, a lot of call center work happens there as well. Do you think generative AI is threatening jobs in these industries?
I mean, the fact is that there would be some jobs which will get lost because they will get automated. But the good news is overall the pie is increasing. Overall, the cake is becoming so large that the new jobs will get created. So I personally believe that upskilling and creating new skills is the India's advantage. And I would consider India is ready for that advantage.
All right, CP Gurnani, we'll have to leave it there, but thanks so much for joining us. CP Gurnani is Executive Vice Chair of IONOS AI on OS. All right, before we leave you, let's take a look at how we are tracking on markets. And we are, of course, closely watching any stock related to Tesla. We saw Tesla have that huge after-hours move. The first quarter wasn't much to write home about, but we expected that. The outlook very warmly received by investors. However, Tesla promising something, be it a new car or a robo-taxi, coming up on August the 8th. Take a look at chip stocks as well. SenseTime, of course, as we've been reporting, suspended after that big 31% jump. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa up next. This is Bloomberg.